Hello, everyone. Welcome to the market update for Tuesday, March the 9th. Have a bit of a rebound in the market today. We'll see if that lasts or see if it can continue to move higher. I still have some concerns with the broken chart of the NASDAQ and NASDAQ 100. We'll take a look at those here in just a second. As far as the direction alerts, the pullback is definitely, been deep enough to where, we're definitely not in any sort of a stretched situation here, but we're kind of right in the middle. And that concerns me a little bit because when you're in a situation like that, it could mean that things are going to get worse, or we're going to get a bigger sell-off where things start to become oversold. Or things could rebound. And if they rebound, one of the things I've talked about is we didn't have a deep enough pullback to where there was enough fear generated in the buyers. And if you remember back when I went over the Elliott wave stuff, remember, what are the conditions of a bottom? A bottom, you don't feel like buying when you're at a bottom. You're scared to buy when you're at a bottom. What's going on right now is, and I've talked about this for a number of weeks, is that we've just got there's such a strong bullish sentiment in the market that that every dip is getting bought. Now that'll work for a period of time, but what creates that panic selling that leads to a major bottom is when that dip buying doesn't work, and that's going to happen at some point in time. And what concerns me is with that breakdown of the QQQ chart, we'll look at it here in a second, it really does look like there's still further we could drop, and because but there again, it is still possible we rally back up again and probably not go to new all-time highs on the Qs. That has quite a ways to go to get to that point. But we've already seen the Dow at new all-time highs. It's now an all-time high today. The S&P and the Russell 2000 aren't too far behind. And the problem is, though, is I don't know that if we do rally higher in those other indexes that it will go much higher. Meaning that this could just be a short rally. It could mean that dip buying did work again, but it also means we're probably that much closer to getting that big correction. And what I was kind of hoping for is to get that big correction out of the way, so that we can really start getting focused on stocks that could now start long sustained rallies that we can kind of participate in for several months, because you remember, markets always fall a lot faster than they rise, and so in order to get those sustained rallies for several weeks and several months, you got to kind of get that flush out move. Otherwise, you'll just keep barely going to new highs and then getting these sharp sell-offs, and it's harder to, then you have fewer stocks participating, so it's harder to be in the right positions. Whenever you're in a market where the market is doing well, but all the trades you're in are not even moving that day, or they're down, that's usually a sign that the rally is very narrow, meaning there's only a few stocks that are driving the rally, and it's harder to be in those stocks. It's harder to find the right stocks. Where it's easy to make money and where you have a better chance of making money is when you have that broad participation, when the rally is going up and almost everything's going up. Doesn't matter what you pick, it's going up with it. Maybe not the same amount, but that's a good problem to have, where your stock is only up $3 today. There's 3 or 4 others you're following that are up $5, but that's a good problem to have when you're not making as much as you would have in some other stocks, but you're still making money. And so we'd like to find those conditions where there's a broad rally and there's not such a narrow movement there. In fact, that's always a warning sign that it's a good time to sit on the sidelines. If you're going through your charts, or you're going through and looking for trades and you're not finding a lot, one of the things I always tell people is I can find a trade every day. I just can't. There's going to be some pattern I can find that I can feel like I could make money on. But the question is, should I be making that trade? If there isn't broad participation, the probability of that one trade I'm finding working out is a lot lower than if there is broad participation in the market. So that's one thing we want to be concerned about a little bit. As far as the signals, though, again, we're kind of right in the middle. Momentum's right in the middle there. Breadth is right in the middle. Again, we could be sliding either way. And sentiment's a little bit on the higher side, but still kind of more in the middle or closer to the middle. And then you go and look at the buy-sell ratios. They're basically right in the middle. There's no extreme here. Now it is looking like with the recent buying that maybe the buys are going to start moving up there, and we definitely would see that if we see the other indexes move to new all-time highs. But we've seen this whipsaw here. They came closer together here. The buys moved up, and then the sells moved higher here. And the buys moved lower. So we don't have a clear direction as far as the buy-sell ratios as to what's basically could go either way from here. Sentiment is down it's down lower, but again, you could reach, as you get these bigger sell-offs, it could reach the lower extreme down here, which, as you can see, would tend to be more bullish. We get to that fear in the marketplace. You can't always know when you're at the exact bottom, but you can usually tell when you're pretty close. And when it spikes down to any of these extreme levels, when it spikes to the upper level, you're probably pretty close to a pullback. You want to be very cautious there. When you get down to these lower levels, you want to be more aggressive with your buying, because usually you're going to be snapping back and going to be starting to rally back up. You may be a little bit early where it still has a little bit further to drop, but that's a good spot to be very aggressive in your buying, is when you get down to that lower extreme. And you can see we're right here in the middle, and that's always a tough place to trade, is when it can go either way. And I'm not saying that you still can't make money in those conditions, but it can also lead to a lot of whipsawing and being on the wrong side of trades if you're not picking the right stocks to be in. All right, let's go over to by the way, the training today is going to be, we're going to continue on the option, talk about options. We're going to get into option pricing and learn a little bit about how those prices are set for the options. So we'll get into that after we do the update. Let's take a look at the SPY. You can see now that we've rebounded for a few days here, it's possible this is just a correction right through here. You can see it's more choppy, more back and forth. We didn't drop below this low, so we didn't go to a lower low on the SPY, so that is a reason to be bullish. And with today's move, as we get closer to that breakout area, it becomes a little bit more probable that we could break out. So I wouldn't be surprised if we do rally a little bit further and break out to new all-time high in the SPY. I'll have to see how we close today. I don't see anything that would. Volume is going to be a lot lighter today, which is a little bit of a concern. But again, what I'm really been focused on is the NASDAQ. And let's take a look at NASDAQ. We'll come back. Well, the Dow is breaking out to new all-time high. Again, we'll see if that holds. Remember, yesterday it broke out, but then faded into the close quite a bit. That's what I'm talking about today. I don't anticipate that'll happen, but it's possible that it could fade in the close, and then it could look a little bit different than if that were to happen. Now you can say, well, Jerry, if the Dow is breaking out, could it be now leading the way for the rest of the indexes to go higher? The problem I have with that is when we talk about leadership stocks, and obviously what's been the leadership over the last several months has been the NASDAQ not even the Nasdaq 100 stock. It's been the small caps in the Nasdaq index that have been driving the move higher. A lot of electric vehicle stocks have taken off. Just some of these smaller startup companies, the SPACs have been having tremendous moves up until recently. And when you have leadership, let me go to the QQQ chart here. When you have a leadership within a market, that leadership doesn't change, doesn't shift or change quickly. Meaning, what happens in these cycles, and you can see it over years and years and years. I've been doing this a long time. Is that when a leadership changes, it changes after a big sell-off. It's when things get broken down, things get hammered, and that fear gets into the market. People, all these stocks they love that made them all that money going up. That's why they're the leadership stocks. They break down and they no longer work, and they get to a point where nobody trusts them anymore, nobody likes them anymore, and then they start looking for new leadership. And then that's usually what leads you out of these big pullbacks and these big collapses is a new leadership group, and that cycle kind of repeats itself. What the mistake a lot of people make is that when you get a sell-off in the leadership stocks, and then the market starts rallying in another area, money starts going into industrials or cyclicals or something like that. They assume that that's now the new leadership. But what's really going on is it's actually a panic move. Now that they're not making any money in their leadership stocks, they want to find something else that's going to go up. And so they start looking for stocks that have been kind of underperforming the rally, and they dive into those, and those start to rally, and it makes it look like the rally is going to continue. But that's kind of the last ditch effort before breaking down completely. And it's kind of that desperation buying is what I like to call it. And so it makes total sense when we have a breakdown in the NASDAQ 100 because it's been the leadership. And let's look at a little bit longer term chart here so we can see the breakdown. Some might be new on this update here, but we had this trend line right through here, and it held it right here. It even held it right here. It bounced off of it right there, but then it broke through it. And now what we're seeing it rally. And I know that's not a straight line. I'm trying to draw as straight as I can. But we're rallying back up to the underside of that. And we've got this horizontal support resistance along here. I'll zoom in and we can look at this a little bit more closely. But it's going to be very unlikely that the NASDAQ 100 comes all the way back and breaks out. Not impossible, but this was a big bearish warning sign. I think it's probably more likely that the NASDAQ ends up down here in this area than breaking out to new highs. Now, again, as a trend trader, I'm trying not to get too focused on predicting. I'm not trying to be Nostradamus. I'm just trying to follow the trend. But understanding how trends work and when they break down, recognize when trends break down. Part of being a good trend follower is knowing when trends are breaking down, and this is definitely a breakdown of the trend. And so, what's happening is that people are starting to abandon, these leadership stocks, and they're going into those Dow stocks. They're going into stocks that have been underperforming the rally. They haven't been the kind of sexy names to trade, and those are kind of driving the move higher. Well, what'll happen is that's that desperation buying. Is when that starts to break down, it's like, okay, where do I go now? You get out of everything at that point, and so when we start to see the Dow and the S&P start breaking down, that's when we're going to get probably much bigger pullback or sell-off. And we'll see if we get enough clues to recognize when that's happening, to see it ahead of time. But I'm going to keep pointing this out until maybe it changes, but this is definitely a warning sign that that this is not a market you want to be overly aggressive in buying right now. And so just be aware of that. All right, so now another thing too that broke down. Not only did it break below that trend line, but also this is a major high back here in I think that's a September 2nd high right here, and it broke below that. It actually closed below it. It traded below it on Friday and closed right at it. It traded below it on Thursday. It traded below it, but closed right at that trend line. Friday it traded below it and pulled out back above it, and then yesterday it closed below it. So that was a pretty big significant move yesterday. Now again, it's rebounded today. We'll see if that rebound can last, but let me zoom in a little bit closer here so we can see. Let me take the volume bars off here. Yeah, I've got a free draw so it's hard to make it a straight line, but you can see where it's broken down below it. And then this is that horizontal trend line through here. It goes back further than that because it goes back to that September high, but this is kind of an area here where it's touched it a few times. It traded below it, and then it closed below that area yesterday. So, all right, so we'll keep an eye on that. Now, moving on to the rest of the market, here's the Russell 2000. Again, I can see where this, if the market does continue to rally, this could still end up breaking out to the new all-time high. It's not very far away from that. It didn't drop below that low right there, go to a lower low. So those trends have held up, but we'll see how that lasts. Like I said, it looks like a little bit of that desperation buying going on. The bonds have been kind of the story here, and I think I talked about this last week. That's part of the reason for that is, whenever interest rates go up, they're really going to affect companies that are trading on expected growth and expected income down the road. They're not making a lot of money right now, but they're expecting to make money down the road. A stock like Uber or something like that they're basically spending a lot of money. They're anticipating that they're going to be able to develop a business plan that'll make them a lot of money later on. But remember that inflation, when inflation hits, it reduces buying power, right? You don't have as much buying power, and so these companies that are expecting earnings down the road, those earnings are going to be lower than what they were anticipating because of inflation. And so that's why we're seeing those stocks get hammered the most through this sell-off. And it's going to be harder for those stocks to rebound as long as there's this fear of inflation taking place. And the rise in interest rates in the bond market is reflecting that. It's reflecting the fear that the Fed is not going to be able to control that inflation when it hits. And that's kind of the big fear right now. And I kind of echo that fear because we haven't seen a real strong inflationary condition for a long time. And the Fed was able to deal with it, kind of last time when we started to see, we didn't have a bad inflation problem, but we started to see a little bit of inflation, and they were able to deal with it and successfully. But right now, we're throwing so much money at the economy, more than we've ever thrown, and that's always scary because when it hits, it could hit big, and you can see interest rates skyrocket to try to control the inflation, and you could get these big swings back and forth. It could get out of control pretty easily if we're not careful. So the market is kind of reflecting that uncertainty, and the big the irony in this is that it's all based on the fact that we expect that we're seeing that the economic conditions can improve very, very rapidly. So in other words, if you start to see news that the economy is roaring back quickly, and that's going to be actually bearish for the market in the near term because of that inflation risk. And so good news could end up being bad news in this situation, at least until we start to see, unless we start to see economic growth come back strong and we're not seeing big inflation, then the market could really take off out of that. But I think we're going to continue to see worry when people talk about, everyone going on vacation as soon as these mandates are lifted, and we'll see we'll see how that ends up playing out. But you can see that with TLT here, it's really oversold. It's come down quite a bit. You could get a little bit of a bounce where bonds could rally a little bit. We're starting to see that a little bit today, but the trend is still lower, and we're going to assume it's going to continue lower. We got a little bounce right here. It looked like these are going to rebound, and it rolled right back over again. But that trend is still lower. Gold had a little bit of a bounce today, but it's been lower. Again, we've had some of these bounces before where it looked like it might rebound, and it's continued to go lower. So the trend is still down. Now, the problem with gold is that the most recent lower high was right here. So we really need to get above that area before we'd really be able to be confident the trend is reversing. In the meantime, you'd want to look for little smaller, higher highs and higher lows that could indicate that it's showing some signs of reversing there. It definitely is oversold, so it's due for at least a little bit of a bounce. You're not quite in the extreme oversold range, but you're down in the you're definitely oversold in that oversold area. Oil's opposite. It's been in a strong uptrend. Pull back a little bit the last couple of days, but that trend is still intact. The dollar has still been strong, and you've got the higher high, higher low now in the dollar. It's down a little bit today. I'll see if that's just a little bit of a pullback. So this is what I was talking about with gold. So here it broke above the higher high right there, right? It's gone to a higher high. Before it did that, though, you had these little subtle higher highs, higher lows. Actually, this was a kind of an even high right there. Higher low, though, right there off the bottom. But it started acting a little bit more like an uptrend, and now that's broken out, it's looking more like it's acting more like an uptrend. Each of these little pullbacks, so you want them to rebound and go higher if that trend is continuing. It looks like we're in a little bit of a trend reversal here on the dollar, going from this downtrend, reversing into an uptrend. And the VIX has been lower. We had that little bit of a spike last week, but it's come back down again. So the VIX isn't showing any fear yet, but that's part of that's something I look for is a signal of a bottom. As you get these really big sell-offs and you get a real big spike in the VIX, the fear is just not there in the selling, and it's hard to say you're at a bottom without getting that reflection of fear. Remember, we're talking in this case fear with the institutional traders. Because they're the ones that are doing this. They're the ones that move the market, and that when you start to see the market sell off and the VIX really spiking up, that's when you know that you're getting one of those big sell-offs. All right, let's go over just a couple of stocks here, then we'll get into the training. Retail, I've gone over this one before. but it still looks good. Big 5 at the top of the list, 96 strength rank. BGFV is a ticker symbol. It went briefly to a sell signal on that selling last week, but it didn't. Here was a previous low right here. It didn't go to a lower low. This could be a little bit of an ABC pattern. The last couple of days it's been up. But there again, usually when you're in a strong trend, I can go into this hold list and I've got a whole bunch, especially if you're at the top of the list, or you're one of the top sectors. It's been one of the top sectors, this retail sector for a while, but there weren't a lot of stocks I really liked in it. And so that, usually when you're having trouble finding some good trades, that's again a sign that maybe it's not the best condition to be trading in, or at least being aggressive in. Under transportation, come down a little bit here. I like this DAC, 97 strength rank. A little bit of a pullback here, but it looks to be kind of holding that trend line. If you draw a line up it seems to kind of pull back to that trend line. It looks like it's moved up a little bit today. You want it to hold this breakout area right here. That was a previous high where it pulled back. Again, those kind of the ABC type look on the pullback, had the initial sell-off, kind of moved a little bit sideways here, the bounce, and then move down before going higher again. But it broke out, so that each of these breakout areas are significant. See how it came back? This thing traded down to that breakout area and then came back up again. Here's where it closed at the end of the day. Here it traded down there a couple of days ago. And so could it still pull back a little bit further? Yeah, it could pull back into here and still be okay. If it breaks this, though, now you've broken the trend. And you probably wouldn't want to trade at that point. It'd be a little bit too risky to be trading at that point. Another one I've gone over before on computer technology that I like, I still like it, is this MVIS. It actually has a 100 strength rank on it right now, but it's had a little bit deeper pullback here. Looks like a possible ABC pattern. Remember, I think I brought this up last week. I just said, we'll just wait to see if this is a C leg, and when that C leg is done going down, we said it could still drop down a little bit further, and it did. Today it had its first bullish day, though. It looks like it's going to close higher than where it opened. So if that is an ABC pattern right here, it could be starting a new uptrend. It was important that it held that breakout area. There was a previous pullback right here. It broke out of that area. It has an intraday low on Friday that touched that area and then came off of it. But I like the reward to risk on something like this. You could wait for it to go back to a buy signal to get a little bit more confirmation. But this is one you could even trade on a day like today if you're going to have a stop that's below that breakout area in case it isn't done going down. And if it does break down below that, it's probably a broken trend at that point. You probably want to stay away from it. But I like that pattern there. And then under business services, down here, I like this Futu Holdings, FUTU, 98 strength rank. Very similar. We have nice big uptrend right here. It looks like wave A, wave B, wave C on a pullback. And then you have a nice little bullish day today. Looks like it could be starting a new uptrend, a new upward move. And then for those of you that are into the Bitcoin, there's let me find business services here. There's Riot, RIOT, Riot blockchain. a 99 strength rank. It also has a nice pullback here. Nice little bullish day. Now this will probably move in line with what Bitcoin is moving, so you can kind of look at that chart. If you got a chart of to see how Bitcoin is moving, you could kind of watch that, and this will probably move along with it. But that's a nice little pullback there. It's pretty deep though. This pullback is pretty deep. So if this really needs to be the start of the rally back up. If it goes any deeper than that, it's probably, it could be a trend reversal. You could be in a downtrend, and this is probably about as far as I'd want to see it drop. All right, let's get into trading. Next second here. The allergies are kicking up with all the pollen in the air now, so I'll take a few drinks of water here. All right. We're going to talk about option pricing. And let me, real quickly here, when I'm thinking about it, I'm going to have to probably log back into my brokerage account. All right. A couple of the terms that we need to get familiar with. This will all be kind of under the option pricing kind of section, how these options are priced. A few bits of terminology we need to learn about is what is in the money, at the money, and out of the money. And real key to understanding option pricing is understanding intrinsic value versus extrinsic value. We'll also, probably not in today's class, but we'll also get into historical volatility versus implied volatility. This can be, the implied volatility is really kind of difficult to grasp for most people, especially if you're trying to be able to well, I can show you, I can tell you what the formula is of how these options, how they get priced. It's called the Black-Scholes pricing model. So at any point, if you want to know the mathematical equation for these and what are all the inputs of these, I'll let you go study that on your own. There's plenty of information. If you just Google Black-Scholes pricing model, it'll give you all the information you probably need. The good news is you don't have to know that mathematical formula. I couldn't use that formula to save my life, and yet I've been trading options for 20 years. So the good news is if you don't want to mess around with the pricing model there, you don't have to. The way I explain it is, I don't have to understand how a calculator works in order to use a calculator, right? But there's people that just have to know how to use a calculator or how it works, and I'm not that person. So you're going to get this from this education from the standpoint of real simple. We don't need to know how some of this works in order to be able to use it. And then I'll leave it up to you guys that want to dive into the deeper aspects of it. If that'll satisfy your curiosity, you can go ahead and do that on your own time. And I'm not the one to teach you because I don't know that stuff. We also are going to learn about the effect of time and time value, and this is going to be important because in one of the later classes we're going to put all this stuff together, and we're going to go through a process of trading options. What strike price do I choose? What expiration date do I choose? And some of those decisions are going to be based on understanding some of this background stuff. Okay. All right. To begin with, let's figure out, or let's learn about in the money. an option, a call option is in the money, and we'll look at examples of this. It'll be in those examples, it's usually easier to understand after we go through the definition. A call option is in the money if the current market value of the stock is above the strike price of the option. So if we pull up an option chain here on, we'll pull it up here on Apple. So we're talking about what is in the money for a call option. The current price of Apple is $121.21. So if the strike price is below, for a call option, if the strike price is below the current stock price, then that option is said to be in the money. So let's look at the $120 strike. $120 is lower than $121.21. So that would be an in the money call option. Another term for that, or another way to understand in the money, is that option has equity. So if the stock is at $100 and I buy the $95 call option, remember, I'm buying the right to buy the stock at $95, and the stock is at $100. The current market value is $100. That option would have equity of $5. That option would have to be worth at least $5. The price would have to be worth at least $5. Okay. Now, if we go back to the option chain right here, most brokers do this, but it helps a little bit. It'll shade in. You see how this is all yellow right through here? It'll shade in the money options right there. So all these strikes, and we can look at more strikes than these. Right now, most brokers do this too. There could be a lot of different strike prices, so they'll usually set them to where you don't have to look at them all, because most people trade strikes that are near the current price of the stock. So that's why this is showing this many right here. I can change that. I can look at all of them, and it'll pull out a whole big list of all the different strikes. But all these that are shaded in right here are in the money. They all have equity. Okay, if I'm buying the stock for, or if I'm buying the $119 strike, the right to buy the stock at $119, and the price is a little over $121, that option is going to have to be worth at least $2, right? Well, it would be $2.21 there, because it's in the money by $2.21. So the current ask price is $3.15. Now, I'm going to break this down a little bit further when we get into intrinsic and extrinsic value. But that option has to be worth at least $2.21, in which case it is. It's actually $3.15. So there's another component to that price as well that we'll talk about here in just a second. That's just real easy. Anytime the strike price is below the current stock price for your call option, that option is in the money. Now, it's just the opposite for the put option. The put option is in the money if the current market value of the stock is below the strike price of the option. So if the current market price is $50, then the $55 put, the strike price put, would be in the money. Any strike price if the stock, any strike that's above the current market value of the option would be in the money. So again, it's real simple on the option chain itself. Where it shades it in with that different color right here. So these are all the in-the-money put options. And notice how all these strikes are above the current stock price. All right, at the money. At the money, it's basically when the current market value of the stock is the same as the strike price of the option, or it's usually the strike price that's the closest to the current stock price. Very rarely you're going to have the strike price and the stock price be exactly the same. Okay. So on our option chain right here, with the stock at $121.21, the $121 strike would be considered the at the money strike. Okay, because that's the one that's closest to that current stock price. Now you can see it's also slightly in the money. It's in the money by 21 cents. That's why it's shaded, but this would be considered the at the money strike price, the strike price that's closest to the current stock price. Out of the money is basically the strike prices that don't have any equity. Okay, they're basically all time value, which we'll talk about here in just a second. But a call option is out of the money if the current market value of the stock is below the strike price of the option. A put option is out of the money if the current market value of the stock is above the strike price of the option. And I'm just going to go to the option chain right here. It's a little easier to see it. And this would be the whole unshaded area. So for the calls, these are your out of the money call options, and these are your out of the money put options. So I can buy the right to buy the stock at $124. You say, well, why would I buy the right to buy the stock at $124 if the stock is at $121? Well, because you're expecting that stock to go up. You're expecting the stock to go up enough to where that out of the money option goes in the money, meaning I might expect that stock to go up to $130 or something like that. Now notice how the price of that out of the money option is cheaper. Well, that's because there's no equity. Okay, back here, this $119 strike, you had $2.21 of equity, or yeah, $2.21 of equity. That option would have to be worth at least $2.21. There's no equity if you're buying the $124 strike. But that's why it's cheaper. But you got to be real careful in the option market that you're not just buying it because it's cheaper. Okay. Because if this stock does not get above $124 by expiration, and this only has 3 days to expiration, this one expires this Friday. So if this stock doesn't get above $124 by this Friday, you're going to lose that entire amount that you spend on it. You can't lose more than that amount. That's the good news, but you'd lose that entire amount because you'd have no value. Okay. Now, what helps you understand in the money, at the money, out of the money a little bit better is by understanding the difference between intrinsic value and extrinsic value. Intrinsic value reflects the amount, if any, by which an option is in the money. Again, it's the equity in the option. that was what we were just kind of going over, that if the stock was currently at $45 and you buy the $40 call option, that option, that the intrinsic value or the equity of that option would be $5. That option would have to be worth at least $5. If that stock went up to $46 and you have the right to buy it at $40, that option would have to be worth at least $6. Okay. And it's really easy to know what part of the option price is intrinsic value. You just take the, well, let's do a different one so you can see a different example. So if you take the $120 strike, that's being offered at $2.44. Well, how much of that $2.44 is intrinsic value? Well, just take the current price of the stock right here. I'm not going to go out the extra decimal point, but we're going to say $121.21. Subtract the strike price, the $120 strike price, and what do you get? You get $1.21. So out of that $2.44, $1.21 of it is intrinsic value or equity. And this is where I do pull out my calculator, because I don't have that quick math mind that some of you have that can figure that out immediately. But that means $1.23. There's $1.23 left in that price. So out of that $2.44, $1.21 of it is that intrinsic value or the equity. So what makes up that other $1.23? This is where options can get a little bit more complex. The remaining part of that option is called extrinsic value, which is any other value above the intrinsic value, whatever is left after you subtract out the intrinsic value. What makes up extrinsic value? The number one part of that makes up extrinsic value is time to expiration. That's why typically we call extrinsic value time value. An option that I buy that expires 6 months from now is going to cost me a lot more than an option that expires this Friday, because I'm paying for that additional time. And that's why, you know, when people get involved with options, they think it's real simple. I just go buy an option out. I know the Apple's going to go up. I'm convinced Apple's going to go up in value 6 months from now. So why not just buy an option out 6 months? And I'm going to easily make money, right? Well, no, not necessarily, because you're paying for that additional time. And that additional time you're paying for is not equity. It's not it's decayed, meaning the closer you get, as time goes by, you're losing you're losing the amount you spent for that additional time. So to be successful in option trading, you not only have to get the direction of the stock move right, but you really need to time it, not perfectly, but you need to time it pretty well, because you're paying for that time. And so the sooner it makes the move, the more likely you are to make money with your option. Now, another part of that that makes up extrinsic value is the strike price, the value of the underlying equity or the stock price. I'll explain this, show you this here in just a second. The implied volatility of the option. Now, this is really complex to understand implied volatility. In fact, I'm not going to tackle implied volatility today. We'll get into that on Thursday. A very small portion of that is the risk-free interest rate, which is based on the 90-day Treasury bill rate. But basically what you need to understand is that when interest rates go up, option premiums can go up, but so usually by such a small amount, it's not going to be that's not something you're going to focus on. But again, these are the things that make up that price I'm going over. Number one, though, the biggest portion of it is time value. And here's the Black-Scholes pricing model. This is what basically the formula that produces the theoretical price of the options. Now, a key thing to understand here is that it produces a theoretical value of the option. It doesn't mean that the options have to be trading at that theoretical value. It's kind of like the blue book of used cars. The blue book will tell you the blue book value of the car, but it doesn't mean that that's what the dealer is going to sell the car for, right? If for some reason blue Toyota 4Runners are really popular right now, the blue book says they're worth $25,000, but because they're so popular right now, that dealer can sell it for $30,000. He's going to sell it for $30,000. Okay, so just be aware. But that the Black-Scholes pricing model is a complex calculation that gives you the theoretical value of the option. Now, you don't necessarily need to know that or know how that formula works. But a good example, I can show you a good example of how different stocks can have drastically different option values. And a lot of it has to well, I don't know if I want to go through this week or after we go over implied volatility. I think I'll save that till next week, because you got to understand implied volatility to understand why those prices are so different. Let's just stick to intrinsic value and extrinsic value and time value. We'll look at time value here. So let's go back to our option chain right here. So again, I showed you how you can break down the intrinsic value and the extrinsic value of the option. If we did it on this one right here, the option is going for $3.15. The intrinsic value would be the difference between the current stock price and the strike price. So $2.21 of that is intrinsic value. Which means what's left over is 94 cents is the extrinsic value or the time value. Most of that's going to be time value. Now, what if your option is out of the money? What if we want to buy the $124 strike? Well, because that's out of the money, there is no intrinsic value. There is no equity. So of that 59 cents, there is no intrinsic value. So all of that price is time value. Now, you say, well, why would I buy that? Well, what I'm hoping for is, let's say that Apple goes from $121.21 to $130 by Friday. If the stock's at $130 and I have the right to buy it at $124, what would be the intrinsic value? What would be the minimum that option would be worth? $6. Now, assuming it's Friday and it's 5 minutes before the market closes, there's not going to be any time value left anymore. So basically that option is going to be worth $6. Well, if I bought it for 59 cents and I can now sell it for $6, well, let's say I bought one contract. One contract would cost me $59 to buy that option. And if that stock made that big move by this Friday, I could sell it for $600. Well, now you start to get pretty excited about option trading. Now that doesn't happen very often, okay? But that would be a reason why you might buy an out of the money option, is that you get a lot of leverage. If you get a big move, you could make a lot of money. But there's an old saying amongst option traders that says, if you trade a lot of out of the money options, you'll soon be out of money. And there is some truth to that, although I always tell people it's not always entirely true if you know what you're doing and if you pick your spots. But yeah, if there's a chance that stock can make a big move and you're pretty confident based on your analysis it can make a big move, and you buy an out of the money option for a little bit of money and it makes that big move, you could make a lot of money on an option trade. But it's a little bit more of a gamble, and with gambling means that typically you'll end up losing more money than you make. So be careful. Just don't go buy the option because it's cheaper. Because again, if it doesn't get above $124 by Friday, you're going to lose that whole $59 on that one contract. Okay. Now, what if I went out? We talked about extrinsic value being time value. What if I went out till April 1st and I wanted to buy that same, we'll say let's do the $120 strike right here. We said that out of that price of $2.44, there was $1.21 of intrinsic value and $1.23 of extrinsic value. We'll label this intrinsic with I and this with the extrinsic value. Well, let's say I go out more time. This is 23 days to expiration on April 1st. That same $120 call option is going for $5. So out of that $5, how much of it is intrinsic value? It's the same. It's the $1.21 of intrinsic value. The rest of that price is $3.79. That's extrinsic value. So I'm paying more for that option. I'm paying almost twice as much, a little over twice as much for that option. So what am I paying for? In this case, I'm paying for that time. I'm paying for that extra 23 days. But you see why I can't just buy this option and say I'm going to make money because I know the stock's going to go up in the next 23 days. I'm paying for that additional time. Okay. So I need it to go. I need the stock. What I need the stock to do in order to make sure I could break even, this stock would have to go up to it would have to go up to $125. If this stock is at $125 on April 1st, April expiration of that expiration date, and I have the right to buy it at $120, what would be the intrinsic value of that option? It'd be $5, right? What did I pay for the option? I paid $5 for the option. So I need the stock to get up to at least $125 by that Friday in order for me to break even. Now, that shouldn't be a problem if I'm expecting it to move right now, expecting it to go right now. But you got to be aware that it's, just buying extra time is not necessarily going to ensure that you make money. You need to. So what happens is you have to kind of, and this comes with just learning how to read your charts and things like that. And you can start to not only know how far a stock could move, but also about how long it might take to make that move. You remember when I'm going through a lot of these updates, when I'm going through these charts, how sometimes I'll show you like here's an inverse head and shoulders pattern. If it breaks out of this area, it has a tendency to go this far. Well, I can use that knowledge to know how far a stock has potential to go. And then if I've traded a lot of those patterns and I know about how long it might take for it to make a move like that, I can really get good at trading options, because I can not only combine the expected move I'm expecting that stock to make, but also how much time it might take to make it. Now, I'm going to give you some guidelines. I don't know if it's going to be next week or the week after. It depends on, I know I got to wrap today's class up, but some general guidelines to start off with as far as what strikes to look for and how much time to buy. There's a basic kind of starting point that works pretty well when I've taught people how to trade options, and then you can start to adjust it. Just realize that I'm not going to be using that model, because that's a starting model. Because every time I teach that, people say, well, when you're trading options, you don't buy that much time, and you don't, you take a little bit more risk going a little bit out of the money on the strike or something like that. Well, again, because I know what I'm doing. But I'll give you kind of a starting point it's kind of a safer starting point with getting your feet wet with options, and then you can kind of make that, you can start to adjust that as you get a little bit more experience. But we'll get into that a little bit later. So next week, or next Thursday, we'll talk about implied volatility, historical volatility, talk a little bit more about time value, and we'll talk a little bit more about these prices, and it'll start to click a little bit better as we learn some of those other concepts. Okay. All right. Now, again, a good way to practice all this is to do a paper trade. Write down, let's say I'm going to trade Apple this week, and I'm going to buy that $120 strike. You can maybe even practice buying the April 1st $120 strike, and then watch it during the week. It'll either go up or down based on how Apple is moving throughout the week. And so you can kind of see a little bit of that potential of how you can make or lose money with options. And it'll help these concepts become a little bit clearer as well. But don't panic if it's confusing, and it just takes time. Just got to kind of keep going over it. And like I said, as we keep looking at examples and we start getting into the process of placing these trades and things like that, it'll start clicking for you. All right. Thanks, everyone. Have a great week. We'll see you on Thursday for the next update. Bye now.